You know the industries people talk about when they discuss power: oil, banking, technology, defense. These are the names that appear in books about corporate influence and documentaries about who controls what. None of them is the right answer. The industry that actually runs the world operates so quietly that most people interact with it dozens of times in their lives without ever thinking about how it works or what it actually controls. It sits behind every mortgage ever signed, every skyscraper ever built, every plane ever flown, every hospital ever opened. Without it, none of those things could exist. The insurance industry manages approximately $40 trillion in assets. It employs tens of millions of people across every country on Earth. And through a mechanism so simple it is almost invisible, it has accumulated a position of structural power over the global economy that no government, no tech company, and no oil cartel can match: the float. To understand how insurance became the engine of modern capitalism, you need to understand one concept: float. When you pay your insurance premium, monthly, quarterly, annually, that money does not sit in a vault waiting for your claim. It is invested. Insurance companies collect premiums in advance and pay claims only when they occur. In between, they hold an enormous pool of capital that belongs, technically, to their policyholders but is controlled entirely by the insurer. This pool is called the float. And for the largest insurance companies, it runs into hundreds of billions of dollars. Warren Buffett understood this decades before most of the financial world caught up. When he acquired National Indemnity, a small insurance company, in 1967 for $8.6 million, he was not buying an insurance business. He was buying a float-generating machine, a mechanism for accumulating capital that he could then deploy into investments while waiting for claims to arrive. Today, Berkshire Hathaway, the company that Float built, is one of the most valuable businesses in human history. Its float currently exceeds $160 billion. Buffett has described it as better than free money.
Was buying what looked like cheap stocks. Berkshire Hathaway looked like a cheap stock.
The insurance operations are themselves profitable, meaning Berkshire gets paid to hold the float rather than paying interest on it. Every major insurance company runs on this same principle. The difference is that most of them do not talk about it in those terms. What insurance actually owns. The float does not sit idle. It is invested. And the scale of that investment makes the insurance industry one of the largest single holders of financial assets on Earth. Insurance companies collectively own approximately $40 trillion in invested assets. They hold significant equity stakes in virtually every major publicly traded company. They are among the largest holders of government debt in every developed economy. They own commercial real estate, infrastructure, private equity stakes, and corporate bonds across every sector of the global economy. The insurance industry does not announce its ownership. It does not send representatives to press conferences or publish lists of the companies it controls. But behind the shareholders of most major corporations, somewhere in the ownership structure, are insurance companies deploying their float into assets that generate the returns they need to pay future claims. When people discuss who actually owns corporate America, who sits behind the institutional shareholder layer, the answer includes not just the index funds and pension funds that get most of the attention, but the insurance companies operating behind them. Insurance decides what gets built, but the ownership of financial assets is only the most visible layer of insurance's power. The deeper layer is more fundamental. In the modern economy, you cannot build something without insuring it. You cannot mortgage a house without home insurance. You cannot open a hospital without liability coverage. You cannot launch a satellite, build a bridge, operate a nuclear power plant, or fly a commercial aircraft without insurance policies that make those activities legally and financially viable. Insurance does not simply cover risk, it validates it. When an insurance company agrees to cover something, it is making a judgment that the risk is calculable, manageable, and acceptable. When it refuses, it is making the opposite judgment, and that refusal carries consequences that no government regulation can easily override. This is where the industry's power over the physical economy becomes most visible. In recent years, insurers have begun withdrawing from specific markets not because of regulatory pressure, but because their own risk models tell them the exposure is no longer viable. In coastal Florida, major insurers are not renewing policies. In parts of California, companies are exiting the market entirely. In the energy sector, Lloyd's of London syndicates and major European reinsurers have begun refusing to insure new fossil fuel projects. No government mandated these decisions. No legislature passed a law. The insurance companies looked at their models, calculated their exposure, and made a business decision that is reshaping the physical economy faster than any climate legislation has managed. If insurance won't cover it, banks won't lend against it. If banks won't lend, it doesn't get built. 2008 and the center of the system. The moment the insurance industry's centrality to the financial system became impossible to ignore was September 2008. AIG, the American International Group, at the time one of the largest insurance conglomerates in the world, had moved into a product called the credit default swap. A credit default swap is essentially an insurance contract on a debt instrument. The buyer pays a premium, and in exchange receives a payout if the underlying debt defaults. AIG had sold hundreds of billions of dollars worth of these contracts to investment banks that needed them to satisfy regulatory capital requirements and to hedge their exposure to mortgage-backed securities. When the mortgage market collapsed in 2008, the claims came simultaneously. AIG did not have the capital to pay them, and when AIG collapsed, the entire global banking system, which had relied on AIG's contracts as a form of protection, became simultaneously exposed. The Federal Reserve provided an $85 billion emergency credit facility. The total government commitment to rescuing AIG ultimately reached $182 billion. The rescue was not primarily about insurance. It was about the fact that every major investment bank on Earth had structured its risk management around AIG's guarantees. Insurance was not a peripheral player in the 2008 financial crisis. It was the mechanism that connected every participant in the financial system to every other participant. When that mechanism failed, the entire system failed with it. Reinsurance, the layer behind the layer. There is one more layer that almost nobody outside the financial industry ever discusses. Reinsurance, the insurance companies that insure the insurance companies. Munich Re, Swiss Re, Hanover Re, and General Re are names that do not appear in mainstream financial coverage. They are, collectively, the ultimate backstop for virtually all organized risk on Earth. When an insurance company issues a policy it cannot hold entirely on its own balance sheet, it transfers a portion of that risk to a reinsurer. The reinsurer holds the catastrophic tail of the distribution, the scenarios too extreme for the primary insurer to bear alone. Munich Re manages assets of approximately $300 billion. Swiss Re manages approximately $250 billion. These companies set the price at which risk can be transferred at scale. When reinsurers raise their prices for a particular category, hurricane coverage in the Gulf, wildfire exposure in California, flood risk in South Asia, that price increase flows through the entire insurance market and eventually to every policyholder, every mortgage, every business operating in those regions. The reinsurers are the market makers of the global risk economy. They are also virtually unknown to anyone outside the industry. The oil industry extracts what is underground. The technology industry moves information. The banking industry moves money. Insurance does something more foundational than any of them. It makes everything else possible by determining what risk is acceptable, what it costs to bear, and who is allowed to bear it. The $40 trillion in assets it manages is the financial product of a mechanism, the float, that is as elegant and as quietly powerful as any financial innovation ever produced. The industry that secretly runs the world does not need headlines. It needs premiums. Like and subscribe for more on the power structures most people never look directly at. Drop a comment. Did you know insurance worked this way? Thanks for watching.